Hello, traders. It's Melissa with Price Plan Profit. Today, we dive into risk management, your first line of defense in trading. Why does risk management matter? Because consistency is greater than random wins. It preserves capital over time, and you trade with confidence, not fear. Let's talk about using a percentage of capital, typically 1 to 5% per trade, versus allocating an amount that you are comfortable with going to zero in the rare case that your trade loses all value before you're stopped out. I personally have traded both ways and found that once I switched to a set allocation I was comfortable with, and of course my account could handle, I was able to trade my plan with less fear and way less emotional reactions. Both ways require you to trade with discipline and honor your stop losses. If you're struggling with fear while in a losing trade, consider decreasing your risk per trade for a while until you feel more confident. Let's talk about position sizing. Position sizing is how you translate your dollar risk into shares or contracts, so your risk stays constant regardless of the stop width. For a percentage based risk management, you're going to take your account balance times your risk percentage and then divide that by the entry price minus your stop loss price. This ensures you risk, say, 1% of your capital whether your stop is 50 cents or $5 away. For a set allocation type risk, if your stop loss level is close to your entry, then you can buy the number of shares or the number of options that equal 100% of your allocation right at your entry. If the stop loss level is further from your entry, then you can scale into the position with 2 or 3 planned entry levels and divide your allocation by the number of entries and then purchase the shares or options that fit within each of those dollar amounts. When you know your exact exposure, you trade with conviction because you can't accidentally risk too much. Stop loss at technical levels. For instance, below support or above resistance, not arbitrary dollar or percentage levels. It protects from structural invalidation. Your stop should live where the setup breaks. Below support, above resistance. Arbitrary stops can be very frustrating because you may hit that dollar amount or arbitrary percentage amount and stop out only to watch your zone work, but you've already exited your trade for a loss. This used to happen to me way more times than I'd like to admit. But now I trade with an allocation per trade I am comfortable with and don't stop out unless my zone is invalidated. Let's talk about risk to reward. Aim for a 1 to 2 or higher risk to reward ratio. Even if you win only half your trades, you stay profitable. Your risk is your entry price minus your stop loss level, and your reward is your target level minus your entry level. Now, have you ever heard of drawdown? For me, when day trading, I cap my daily drawdown at 4% of my account. If I hit it, I'm done day trading for the day. There is always tomorrow. Protecting mental capital is as important as the cash. Let's talk about diversification and correlation. Avoid 100% allocation in one sector. Check correlation metrics. Most trading platforms and brokerage accounts allows you to look and see how evenly diversified your portfolio is. We want to spread risk across uncorrelated assets. Even small accounts benefit from diversification. Don't cluster all your risk on one theme because if, for instance, the tech market has a huge down day, you don't want all your trades to go with it. If you found these risk management rules useful, hit the like button, drop a comment with your number one risk rule, and subscribe for weekly trade strategy and money management tips. Grab your free trade plan and risk checklist in the description. And as an extra bonus, join me tomorrow morning at 8 o'clock Eastern Time where I'm going to do my very first live stream. I'm going to go over 6 to 8 swing trade setups that I'm looking for an entry so that I can trade them next week. I look forward to seeing you then. Have a great evening.